Liz, you're one of those with a bit of caution for the outlook over the next couple of months?
Yeah, I would have caution in September. And I think what you're seeing, especially in the sector patterns today, is just what Mike said, that there's some concern over growth and the economy is slowing down. And you look at things like the economic surprise index, and obviously we're disappointing or missing estimates in economic data more than we were in the first half of the year. But there's also this rotation that could happen through the rest of 2021. And if you think about what happened early in the year, we started the year with cyclicals winning, and then there was this rotation that took shape in May or June, and growth won all the way through summer. So what could happen here is just like what happened in May, where we have a little bit of a pause in September, and the rotation goes back to that cyclical trade, that value trade, as the economy sort of finds its footing through the rest of the year. And I think that's very possible.
Yeah, I mean, just to dig into that a little bit more, Delano, I mean, we do have a yield on the 10-year today that's at 1.37. And typically what we have seen in the past is when you've started to see those yields tick up, some of those cyclical and value-oriented stocks have followed suit, and yet that was not the case today.
Yeah, exactly right, Morgan. I was just going to point to that. And we haven't seen that. And that, as you mentioned, that wasn't the case. But to echo the sentiments of our other guest here, there has been sort of a move to the more of a defensive side. You're seeing real estate, you're seeing, you're seeing financials move forward a little bit. And that last week, you're seeing that healthcare move as well. But I will say that, there still is room, especially with the Netflix has made. There's still room for a company in some of the big bang names like Netflix and Amazon that have kind of been lagging for a bit of a better part of the year to move forward, especially if you look at how their valuations have been prior. So I wouldn't say that's totally take chips off the table when it comes to these growth names, but they should look at some of those companies that they think that they can buy at a lower valuation or a cheaper valuation if there's any sort of correction.
Mike, you mentioned earlier that within the slowdown in cyclicals, industrial's been the focus, but also you could be disappointed by the performance of banks in light of yields rising as well.
Yeah, again, they started off stronger, as did small caps, with yields lifting a little bit. Perhaps it's because the yield move is being attributed to some degree to really more of a supply-demand issue. There's a tremendous amount of issuance coming on the Treasury and corporate side, and it seems as if in a new week, with a more full-strength trading bench, you have people making room for those new issues. On the other hand, I think there is a risk that people are all of a sudden deciding to get in a slowdown mindset when the market's been there for 6 weeks or so, and you've had the economic surprise index lower since the beginning of August. And today, airlines were up and the kind of travel and leisure stocks were up. So to me, it wasn't so clear that people are saying, okay, we're heading for some kind of lasting slowdown. It does seem as if with yields at least being able to be resilient, it's a little more of a mixed story as opposed to one that says we're pricing in kind of a slowdown for months to come.
Liz, I've been seeing an increasing number of notes coming out of Wall Street in recent weeks, starting to wring hands and worry about the possibility of stagflation. I see you bringing it up here in your notes as well today.
Yeah, I think that'll be the next thing that we talk about as the big risk. So once we get past all this taper talk, and I don't think the market is going to have a hard time with the taper, and I know there's a lot of people saying the same thing. I think we're ready for a taper. But then the next concern is, okay, inflation maybe doesn't cool off as much as we thought, and there's still not as much growth in the economy as we hoped for, which is a recipe for stagflation. And the reason that gets troublesome is because the Fed doesn't really know how to fight that. You can't stimulate growth and control inflation with the same tools. So they'd have to make a choice. And I think that's something that we'll talk about maybe on networks like this. I don't know that it's something that's really going to set us back as far as a recovery goes, but it is something that's going to have to affect the market as we move through.